Good afternoon, everyone. Join us for our monthly PropFunders Community webinar. Absolutely delighted for those who've been able to join us live on this monthly sort of educational, informational webinar. Massive hello to Antoine. How are you?
I'm very well. Thanks for having me, David. And hi, Brenda, as
Oh,
well.
Hi, Antoine.
yeah, absolutely delighted you're able to come on. I know you're a busy man. The diary's quite full, but we managed to squeeze you in, which is great. So yeah, really appreciate that. And of course, hello to Brenda, our resident community manager. How are you?
I'm fine.
Good.
All good.
And looking forward to today, Brenda. I'm sure crowdfunding has been a big part of our lives for the last
It has,
seven,
yeah.
8 years.
It's in an interesting place at the minute, so be good to dive a wee bit deeper into it and see
Yeah.
what's what and where we go from here.
No, absolutely looking forward to it. So, without any further ado, I think we will just get into it. Other than just to say, Antoine, you were talking that next week. I know you're obviously in southern France is where you live. I know you travel around the world, but you mentioned you've got sort of a bit of a special visit happening next week to Paris.
Yes, French Open. Oh, yeah, we've been trying to go every year. So yeah, we're quite big fans of tennis. So yeah, looking forward to that. We'll get tickets for 3 days. So
Oh, very
yeah,
good.
that should be fun.
Hmm.
Oh, excellent! Get that on your socials. You need to be on your socials, standing at the French Open.
Yeah.
That'd be good. Okay, so we've kind of done the introductions, but today, of course, we're talking primarily about equity property crowdfunding. But before we get into that, we always like just to do a quick UK property market update. So, what caught your attention this month, Brenda?
Um, the picture's been very samey. I think over the last couple of months, it's really settled. It's very, it's very stable. The base rate has stayed the same. There's not an awful lot of increase in the mortgage rates that are available. They're pretty much the same. I think people are just cautious at the moment. I think global economics and world politics are having their effect in the UK, and people are just that little bit more cautious.
Yeah.
Although the interesting thing, sorry, just on one of the supply and inventory, it is the buyer's market emerging, which is quite interesting, which is hasn't been that way for probably quite a while. So that's an interesting thing to pick up on.
Yeah, no, that's a fair one. Obviously, inflation just came down a bit yesterday in the UK, and I think the plan's still to keep the base rate the way it is. So, shouldn't be any major changes on those two things. Would you keep an eye, Antoine, on things like obviously the normal interest rates and then things that happen in the global economy? I know your background we'll discuss in a minute, but as an investment banker, so would you keep a pretty close eye on those sort of things?
So financial markets definitely. I follow every day what's going on, and especially interest rate policy because it's directly linked to a lot of the investments that we make. I don't follow the big picture slash high level like property related indicators as much, but I do see the consequences or what is tightly linked to everything that's happening in the market. When you talk about smart money moving, for instance, I mean we've been investing in a lot of like loans where developers refinance to give themselves more time to exit projects, because units are not shifting or not shifting at the prices that they want them to shift, and they just buy themselves more time.
Hmm. Yeah, no, that's a
Yeah,
good point.
it's interesting. Yeah, just the fact that they're not looking for quick sales, and maybe this buyer's market emerging is feeding into that, Antoine, where they realize that people are looking for the deals, I suppose, and they're not prepared maybe to pay the prices. So the investors want their exit and they have to do the refinance. I believe David has. Have you frozen? No?
No
No?
thanks.
Okay. Sorry. You're just very still. Yeah.
I,
So,
I hope I haven't, but
mm,
there you are. I am on my phone, just so you know, Brenda. I am on my phone
okay.
broadband
Okay.
because of the or data because of the instability of the Regis office today. So if anything
The
does happen,
other the other issue is that completion. Like I think we're all aware of it too. Is the average time it takes from an offer to an exchange. So that probably feeds into a developer's timelines as well. If they want to get out of a project and want to move on, but they're waiting for a buyer to complete on his mortgage, complete on a sale of a house, it just seems to take so much time now. And we had a session back with John, was it January, February time we did the AI, and you tend to think, oh, AI, the technology is so advanced, there's so much more behind the scenes can be done, but yet and all, the thing with property and mortgages and all of the completions, they just seem to have slowed up even more. And I don't understand why technology is so good and yet our processes have become slower. I'm not really sure where the correlation is or where the lack of correlation is. I don't know.
Yeah, good question. Do you wanna hazard a response to that, Antoine, or?
No, I'm not in the best position to opine on this, but again, yeah, I'm surely we've been experiencing that as investors in other people's projects, for sure. And so he's saying like 17 weeks from offer to exchange, right? So not even to completion.
Yeah,
So yeah, it's like
yeah,
it's a lot
that's
longer
it.
to get to
The
completion,
average.
and
Yeah.
yeah, we know that all sorts of things can happen, and that's going to compromise the smoothness of how this is going to go.
Yeah.
Yeah, not surprised.
Yeah.
Mhm.
Well, what's also interesting is that even despite all the things we've talked about and the uncertainty and global and geopolitics and all the economy factors, that regionally, the house prices continue to rise.
Mhm.
I was just noticing, obviously 7.5% in Northern Ireland, one of the fastest growths. It was just literally on the radio coming into Belfast today. House prices are expected, Antoine, to go past 200,000 average price in Northern Ireland for the first time ever. It's 8 quarters in a row our house prices have risen here in Northern Ireland. So it's interesting, despite all the factors, there's this sort of step by step incremental growth.
Mhm.
Yeah, it'd be interesting to see what the volumes are like. Because yeah, prices are going up, but if there are less transactions going through, then it may be a case of just the higher end of the market, driving the prices up because of that. But yeah, who knows?
Good insight. Good insight. So there we are. That's our sort of market news update. So, okay, so before we get into our topic today, just to remind everyone, this is sort of live recording. If we do encourage people to put questions into the Q&A, don't use the chat box. Sometimes we don't get a chance to answer the questions sort of live on the broadcast, and we're happy to follow up by email or interact afterwards. We tend not to read out people's names because it's a live feed. And we always enjoy people who join us live, but most people do watch the recording at some point on our YouTube channel and sort of catch up at a later date. So today, really, really delighted that Antoine has joined us. Um, Antoine, your background, we've known each other, I'm guessing now, would it be maybe 8 years? That be about right? Eight,
Probably,
9 years?
yeah. Yeah, probably met in 2018, I think. Yeah.
Mm.
Yeah, which
Sometime
is
in
yeah, what's
2018, I
that?
think. Yeah.
Six years? Oh, it's 7 years. Yeah, and right,
Yeah.
exactly. Because I met Karen first, probably a few months
Uh-huh.
before I met you, and of course we met at the famous John Corey event. I think for the first time at his
Yes.
property fortress. I must say, I do miss those events. To be fair, John had a very unique style of hosting
Mhm.
his property networking event, didn't he?
Yes. Yeah, no, it's I wasn't used to going to networking events, and I think the very first networking event I went to was John's event. And yes, exactly as you said, he had his own style. And it was a great event, quite special compared to a lot of other events I've been to since then. Very unique. So yeah, it's one we miss for sure.
Yeah, no, absolutely. So anyway, you were obviously a banker for 11 years, investment banker, Paris, New York, London. So you're really widely traveled. You're obviously a very clearly a professional investor into property. And I think perhaps some of the experiences, frustrations, challenges as you worked with developers. And in full disclosure, you invested in some of the projects on our Leo crowdfunding platform. Um, and that maybe journey and experience maybe drove you or motivated you to start Investables. Do you want to just explain what is Investables and how it came about?
Yeah, exactly. So the Investables is a membership community for property developers where we help them raise private investor finance. So through putting together an investor pack, structuring deals, finding investors, etc. And exactly as you said, it started because we were out in the market looking for developers to invest with and deals to invest in. And where we were seeing the level of communication, the level of information, how the deals were structured just didn't work for us. So we thought that it would make a lot of sense to start advising all these developers to help them structure their offers, put together investor packs in a way that suits private investors like us. And that's how the Investables was born almost 5 years ago now.
Wow, so that's how long it is, 5 years.
Yeah.
I can remember you sort of kicking it off and attending some of the early Zoom things and stuff you did. Is everything online? Do you do any live events, or is it all just online?
Everything is online. Yeah.
Very good, excellent. Okay, well, look, clearly your background in sort of as a banker, but also your experience in property in general, but then crowdfunding specifically. I mean, how many, if you just maybe have top of your head, how many different crowdfunding platforms would you have maybe invested into projects over the years?
So definitely registered on the vast majority of platforms, if not all the platforms, at least the ones that we know of. And we've probably invested in projects on 70 to 80% of them. So it's probably like a good like 10 to 12 platforms that we've
Yeah,
invested in, I think, over the years.
excellent. So you've got a really good handle, if you like, on
Yeah,
this, which is great.
that's a proper track record.
Yeah, and they're also
Yeah.
the ones that we haven't invested in, and it doesn't mean that. I mean, most of the time it was on the back of reviewing the way the platforms were operating or reviewing some of the projects, but just making a decision not to invest.
Yeah.
Hmm. Yeah, okay. So, today's topic is equity property crowdfunding dead? I suppose I'll just ask that question and let you answer it very simply initially.
Is it a
I,
yes or a no?
Yeah, I
Mm.
think it's unfortunately, I think it's a yes for now. Yeah, I think it's pretty much dead at the present time. Yeah.
Yeah, so and probably we should just explain to maybe those aren't aware, probably the last man standing in the equity space was Simple Crowdfunding based in London. And over the last couple of months, they've made a business decision to cease their regulated activity in the equity space. I believe also in the debt space as well, but we're focusing on the equity today. And obviously this is close to our hearts in terms of Brenda and myself, because for over 5 years, we ran an equity property crowdfunding platform. So there's certainly a degree of sadness that the market has ended up where it was. I think, I mean, a good place to start, Antoine, if you go back to 2020, and what I refer to as the cull by the FCA of platforms, I mean, there were over, what, nearly 20 platforms at that point
Yeah.
lost their license in around that cull.
Yeah, so I mean, there's even one more platform that went down more recently, Shojin, that was also active both on the debt side and the equity side, and then went into administration a few
Yeah,
weeks ago now,
Yeah.
maybe like
A few
six to
weeks
eight
ago.
weeks ago.
Yeah. Hmm.
But yeah, definitely. I mean, it's been a bumpy road for a lot of platforms over the last 6 or 7 years. And both on the debt and on the equity side, a lot of platforms have disappeared. The issue with equity is that there were not a lot of platforms to start with. And so we went from probably less than a handful to, as far as I'm aware, zero in the property industry right now. So there's still equity platforms out there, but more active on the startup funding side of things.
Yeah.
The likes of Crowdcube or Republic, so formerly known as Cedars.
hmm
But yeah, in the property industry, there's nothing at
yeah,
the minute.
yeah. And even those two you've mentioned, formerly Cedars and Crowdcube, they actually tried to merge
Mhm.
about 2 years ago, and they weren't allowed to in terms of didn't sort of pass the competition regulator. But both of those argued that if they didn't get merging, they were going to struggle to survive. Such was the challenges around the model. So even the last two that are standing have indicated that it's a challenging model. So yeah, there was definitely over 20 equity property crowdfunding platforms 6 years ago, and now, as you said, Antoine, there is a big fat zero. So why is that? So what do you feel are the contributing factors or the real reasons why, even in more recent times, those that had stood through a lot of ups and downs have now closed? Have you any thoughts on that?
So I think one of the reasons was the deal flow that was very limited on most platforms, and I think there are probably two main drivers behind it. Number one being that equity is actually a concept that is not widely understood in the property industry. I think
Yeah.
there are a lot of developers that are not financially sophisticated enough to understand the pros and the cons of the various funding models, especially the ones involving equity, and when equity should be used. And I think the property training industry is partially to blame for this, because a lot of trainers just encourage developers to borrow, borrow, borrow. Just like borrow money. Okay, just use other people's money, just borrow money, pay them a certain interest rate. So essentially, raise debt and don't worry about anything else. Just raise money to do your project. And it works really well up until the project is a bit delayed or costs start to escalate, and then you suddenly have all those liabilities that you have to repay. You have to service the interest as well, and that's when things go south. So I think, yeah, the lack of sophistication in the property industry and the lack of understanding of how equity works is one of the drivers that's prevented developers from wanting to raise equity and therefore use equity crowdfunding platforms.
Yeah.
And yeah, alongside that, I think the second reason for the limited deal flow is probably on the compliance front. I think there was a lack of enforcement, and there still is a lack of enforcement by the regulator. So a lot of a lot of developers think they can get away with, financial promotions in public spaces, social media, being the number one of these spaces, and pooling passive investors' funds together, so creating collective investment schemes. Yeah, I think the regulator has been doing more in the recent past. There were some articles out a few weeks ago about financial influencers being sentenced and fined. But I think there's a lot more that can be done. And also on the social media platform side, I think there's the regulator expects them to do a lot more as well in terms of preventing illegal financial promotions being made on their platforms, because they've become so prominent these days that a lot of the activity about promotion is happening on their platforms.
I mean, it's interesting, and I'll bring Brendan here now in this because what you didn't say was that there's too much regulation. It's the enforcement of the regulation is the issue, which I thought was interesting because Brendan, you obviously worked on the compliance side of an equity property uh, funding platform for 5, 6 years, and I know you were getting increasingly frustrated that the barrier that had to be reached to be compliant just seemed to be getting higher and higher and higher. Additional sort of rules coming in, the FCA issuing more policy, statements and consultancies. It always seemed to result in almost strangling the crowdfunding platforms from being able to operate. Is that a fair analysis?
Yeah, absolutely. But then the other side of that was you could see, as Antoine said, so many operators in the space going, invest in my project. Here's how you can do it. Ask me how to invest. Just, they were marketing out at will, and there didn't seem to be anybody stopping them. But yet, and all, us as the crowdfunding platform were having to do this, and this before we could even put a post out that had simple text on it, and there was banners on it. There was FRN numbers, all the dates and the timestamps, which were great. But then those were supposed to be the mechanism to identify the good posts, versus the bad posts. So then it would make it easy for the FCA then to enforce it, to go and say, well, look, these guys have got their FRN number that has been signed off by an approved body. This post doesn't, so they're illegal. Let's do something about it. But it just never seemed to happen. And yet, no, all the crowdfunding platforms were doing everything in their power to get a post out, and it took days, literally, to get a social media post out. So, David, at times you'd wanted to react to, say, the budget, something that had come up in the budget, and you wanted to react immediately. You couldn't do it. You had to just go, oh, here's the post that I need signed off, and that could come back, and we had to make amendments, and then it had to go back, and it just was pointless. And it got to the stage where you just didn't think it was worthwhile posting anything or promoting yourself, and that's what was killing the platforms.
Yeah.
They had deals, they just couldn't promote them.
Yeah, yeah. And alongside that, I know obviously, Anton, you're very passionate about that in terms of what you do with investables and showing developers the right way and the compliant way. So I sense a bit of frustration that the enforcement doesn't happen, which then in some ways just muddies the waters. Is that a fair observation?
Yeah, I completely agree with that. And what Brenda, what you just said, I agree with as well. I think there's a big gap between what's happening and what is expected of regulated counterparties. So, crowdfunding platforms, and then the rest of the market. So unauthorized, unregulated operators in the market. And the compliance burden is very heavily on the authorized side of the business. So on the platforms, the rules have become stricter and stricter. I can think of like introduction of a cooling off period after registering on the platform. And all these things are costly. They cost you time. And they cost you money as well, because we may talk about it depending on what regime you use, whether you're directly authorized or through another operator. You have to pay fees to run the platform. So it was becoming stricter and stricter on the regulated side of things, while things were not actually changing on the unregulated side of things. And it just doesn't make sense, right? If you want to protect investors, which is one of the missions of the FCA, of the regulator, then you kind of have to work with like all the operators within the market to try and make it work, not just make it harder for those who are opening up opportunities to the wider market.
Yeah, yeah. Well, when we started Leo crowdfunding in 2018, the monthly fee for the platform as a appointed representative in AR and the regulatory license effectively to operate in this space was about 4.5 grand. You then got to 2013, back end of, and it was approaching £9,000 a month just to exist as an equity property crowdfunding platform. That's before staff, before marketing, before anything else. You're not far off 10 grand just open the doors. So that unsustainable overheads, there's not many business models that can deal with that level of hemorrhage. If you add 2 or 3 staff and a bit of a marketing budget, a little bit of budget for events, you're at £20,000 a month before you blink. And
Plus,
that,
you also had to have cash flow in your bank account sitting to cover
it's a good
whatever
point.
eventuality. So you had money in your account that you just couldn't touch, because you had to say, yes, we have X, Y, and Z, and we have X amount of money in our account that covers, I can't even remember what it was supposed to be covering. I think it was payments to the regulators. No, I don't even
I think
remember.
there was a wind down plan that had the financial promotion or financially regulated companies had to have a wind down plan. So you had to have money in the bank to cover 3 to 6 months of a wind down plan, paying of staff to oversee the wind down of the business, but also just pure just cash flow financials. They wanted a certain amount of money, which in theory isn't a bad thing, but at the same time, when you're already under pressure with your monthly overheads, and then as you rightly mentioned, Antoine, the deal flow, you need a lot of deals happening quickly to keep your cash flow coming in, and it's and that big definitely a challenge. interestingly, if you go, if you, and that's kind of wearing the platform hat. Um, I think the adverse selection trap, Brenda, I know is something that you've talked about before, and that is the feeling that, and it really leads back in, Antoine, what you're talking about, the market's view of equity or developers' view of equity, particularly, that if they can go and get senior debt relatively cheaply and get maybe mezzanine, at a good rate and accessible, there isn't the same need then for equity. And if they're maxing out and getting the maximum LTV, which you alluded to, because of the training companies and the mentorship programs is borrow, 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 then again, platforms find themselves in not as many developers looking for equity. I think what you were saying earlier, Antoine.
Yeah, so just to clarify, when I meant like borrow, 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 I meant encourage developers to borrow to fund the equity portion
Yeah,
of the capital stack.
yeah, yes,
So,
yeah,
go like over leverage themselves essentially,
yeah,
and have a capital stack full of debt.
yeah,
And quite often, unsecured debt or debt only secured by a personal guarantee for
yeah.
the top, like maybe 20, 25, 15, 20, 25%
Mhm.
of the total costs. Yeah.
Yeah, no, absolutely. And then I suppose, so we can move on to the next bit here. But again, certainly what we discovered as a challenge, as our platform, was the liquidity mirage, and that is the amount of projects that were delayed beyond the expected completion date and return of capital date, um, for a whole variety of reasons. Not always the developer's fault, sometimes the developer's fault, but the expectation that, well, you know, in our case, like we had done over 5.5 million equity invested in 24 projects. And you're thinking, well, if 30% of those pay back on time, there's a new pot of money that's just going to be recycled through the platform. So you kind of based your cash flow and your business model on the same money being maybe used 3 times in 5 years. But if the first projects are delayed, then you're not getting a chance to recycle. Um, as an investor side, Antoine, I'm sure you experience a lot of frustration, in terms of projects not coming to fruition on time. Is it fair to say that's probably one of the bigger frustrations within property investment in general and crowdfunding platforms in particular?
I mean, for sure, but it's not about crowdfunding platforms. It's just about the state of investing in like investments in other people's projects, property development projects in the UK. And I want to say now, but I think it's probably always been like this, and I don't see it changing anytime soon. Um, it is certainly frustrating, when things don't go to plan and all that, but that's to be expected with property. And our approach when it comes to using a platform has always been about dipping our toes in the water, like testing the relationship with the developers. So investing a small amount of money in the first project to see how the developer was getting on with the project, communicating throughout, etc. So we were very much positioning ourselves to doing repeat business with that developer, over the foreseeable future, over like many years on the back of that. But unfortunately, it didn't quite materialize into multiple deals on the platform. I think when a developer was doing multiple raises on the platform, it was the anomaly in the sense that the majority of them were just doing one project, and then it would take longer than expected because we were looking at it in terms of like making a small investment of money, but a bigger investment of time and energy into doing our due diligence on someone with a view to investing and reinvesting with them. But a lot of the time, it just didn't materialize, and there was just one deal, and that was it. So yeah, that was a bit frustrating for sure.
Yeah, yeah. And again, I can empathize that. I mean, on our platform, I know we had, I'll not say the developer, but they had 4 projects that all paid out on target. Equity, I mean, all of them were over 20% ROI, most of them 12 months or slightly delayed. But then their fifth project went horribly wrong. which was like, as you say, we got to the Holy Grail. Well, they managed to do numerous projects, so investors thought they were the best developers since sliced bread because they had delivered, to be fair, on multiple projects. So that's what a lot of investors want. Find a couple of developers that they get comfortable with and they're willing to invest in. But even that sort of four successful projects didn't protect the platform from the fifth one that went horribly wrong and investors lost some of their capital
No, looks like David has
on that
frozen.
Yeah.
project.
Yeah,
I
I
think,
actually, oh, now he's back, I think.
yeah.
Back now, you lost
Yeah.
that, did you?
Yeah, you were just saying that they didn't protect the platform basically from the fifth one failing, and that there was no, yeah, it still left a bad taste in the investors' mouths, basically, so.
Absolutely,
Mhm.
absolutely. Okay, I'm conscious of time here, so death by regulation. I think we've covered this a little bit anyway. But is there anything around the regulation you'd like to talk about, Antoine, or just point out in terms of where you feel that has impacted on where we are now with no platforms out there anymore in the equity space?
This should be a bit to talk about was about investor appetite in general for equity. I mean, there's a smaller market in terms of investors who are interested in investing in equity compared to investing in debt, because it's the equity is the riskier end of the capital stack. So you have a smaller market to start with, a smaller pool of prospective investors. And then alongside that, you had some project failures on some platforms, which reduced investor appetite even further, which made it like unsustainable for a lot of platforms, which is a shame. Um, um, but yeah, and also I think something else was from the developer's perspective. Maybe the expectations from some of the developers were a little bit different in terms of what the experience would be onboarding project, trying to get projects funded on platforms. Maybe they were expecting a more hands-off experience, but they were maybe realizing as they were interacting with the platforms that they had to bring some of their own investors because it would be difficult to fund their projects otherwise. And there was a bit of relationship building as well, where they were probably hoping for something a lot more transactional. So I think there was also a bit of a mismatch between what some developers were expecting and what the reality of funding a project on a crowdfunding platform was like.
Yeah, I think that's very fair, very fair. In terms of the public offer platforms, is that something you've looked much at? Do you think it's going to make any difference? Sort of bigger raises being done through this means as opposed to dealing with the retail. Really, that moves crowdfunding into the high net worth sophisticated space and rules out the retail small investor.
Yeah, I think it's just, I mean, it's for larger raises. So I think it doesn't impact the majority of developers, in the space at the minute. So I don't see it as having a meaningful impact on what we do and what your options are. It's raising money on the private side of things, away from the regulated space remains very straightforward. You have to find exempt investors, high net worth or sophisticated, and find one single investor that's big enough for your project, and then just like
Yeah, just what you were saying though on the regulation side of it, you were saying about the developers coming in and they didn't realize maybe how crowdfunding would work. But also then I think as the regulation got tighter and tighter and it took longer to complete projects from whenever they arrived at the platform, they paid their fee until they actually got it on the platform to start raising money. That time just stretched out more and more. And I think that regulation side of it really caused a lot of people to go, no, this is not for me. I don't have 6 months to wait until I get a decision whether or not you're going to be able to raise on the crowdfunding platform. I'll have to go somewhere else. So from that side of it, I think the overregulation really just squeezed and squeezed and squeezed until there was just no more room to breathe, basically.
I agree. I think we reached a stage where the crowdfunding, equity crowdfunding model was no longer fit for purpose, and therefore there was no more demand for it.
Yeah.
For a variety of reasons. Regulation, regulatory burden is a big one. Lack of investor appetite. Not the best operators, doing raises on certain platforms, and projects failing. A lot of factors just played a part. But there was just no more market for it. So equity crowdfunding, as we knew it, there was no more place for it in the property funding scene in the UK. So whether it's gonna reappear in some other shape or form at some point, or it's never going to be an option again, yeah, that I don't know.
Time will tell. I need John Corey's crystal ball, and then we can see whether it comes or not. Brilliant. Okay. Yeah, we talked about that. So yeah, so it's just ready to wrap up then. So if, as you've just alluded to, there wasn't the appetite among investors to go into equity through a property crowdfunding platform, so where is that money moving in your experience? Where are investors investing their money in property?
Yeah. He's probably just basically asking, do you agree with what's on the screen, Antoine? Is this how you see it moving on, or is it going to be no, it's completely dead and just it will be literally one investor, one project?
Yeah, so I think there are two ways to go about doing things now. So the fact that the equity crowdfunding platforms have disappeared means that the equity investments are no longer accessible for the retail side of like retail investors. So investors who are not high net worth or not sophisticated, equity investment is no longer an option for them. So two ways to go about it for developers. You can either raise more debt and go for a higher leverage kind of option by boosting the loan to value, and you can still tap into retail investors by using debt crowdfunding platforms for that. And or you just go private, and which is exactly what you're saying on the slide now, which is just about going direct with exempt investors, so high net worth, sophisticated, that are big enough to fund the equity tranche of your capital stack for a development project. Or even they can even do fund the debt side of things. Step into the shoes of the senior lender, depending on how big there is. So it doesn't make things necessarily more complicated, but it really make developers focus more on certain types of investors. So it's you can put the retail investors aside and really focus on the exempt, so high net worth, sophisticated, and maybe move more into the institutional space. So family offices, small to medium-sized funds, where there's going to be more money to play with, and the regulatory burden is not going to be on you as a developer, but it's going to be more on the funds operating in that space.
Yeah, very good. Just before we sort of wrap up, then we'll do sort of a couple minutes in terms of summary. So if we were to try and do some key takeaways from this. One thing I didn't ask in the first place, what was it attracted you to crowdfunding equity platforms in the first place? What was the attraction?
I think there were a few things. So number one was the availability of investment my investment portfolio as well. And the power of the crowd as well. When you have more people reviewing the same investment opportunity at the same time, you get to leverage other prospective investors' skills and an experience. You get to see or hear what questions they ask. And you can, you dig a lot deeper into the project and the behind the project. So it makes it quite an interesting experience from an investment perspective as well. So I think these are the top three things, that made it quite special to me.
Yeah. Your wife Karen obviously was from a regulatory background. Did you never think of starting your own platform?
Good deals and what do you do with them? So, there's that lack of place to put a deal that someone else can go and look at and can evaluate, can say, yeah, this is a good deal, I would like to invest in it. That piece of the pie is quite hard to navigate around, I suppose, that sort of route that where you want to be able to show it to people that have money, and that the developers are bringing these really good deals and they just have that little piece of the equity or the little piece of the second charge that they need to be able to just get it off the ground and get it up and running. And, unfortunately, there's just not those platforms really there anymore that can do that for them.
Yeah, I think that the developers on the developers to actually fund their deals. Help for them is only in the form of advice and potentially, connecting with professional introducers who can connect them to investors. But apart from that, it's their responsibility, it's their job to go out and find investors to fund their projects. And there are still plenty of good deals to invest in.
Yeah.
And there's still plenty of investors who want to invest in these deals. It's just about,
Connection.
matching the two, matching the supply and the demand.
The old basics of business, supply and demand. It's alive and well. Am I back or not?
Unfortunately, that's not a good place to be if you're coming last minute to look for money that you absolutely need.
Yeah. Exactly. I think it's all
Good. You may close it off, David, before you fail completely on your internet.
It's the Regis internet's just down, unfortunately, in the Regis office. So
Yeah.
look, well, I'll try and just finish off here briefly, just from the recording point of view, and hopefully we'll get the next couple of minutes in before we conclude. To think I drove the whole way to Belfast to make sure I had good internet today.
Yeah, I was laughing at that.
The joys. But for those that like podcasts, we've got a really good array of podcast guests. One of the last ones we did, someone that I would know. You hear me, Brenda? No, am I just
not really? No, you're just
right,
breaking
okay.
up a little bit. Yeah.
I think we just need to end the call then. Look, yeah, okay. Unfortunately, we can send an email anyway. Look, Antoine, can I thank you or Brenda if you on my behalf want to just do the wrap up then, and then I can finish when you're finished.
Yeah, okay. Yeah, we thank you very, very much, Antoine, for coming and enjoying this. There's been some amazing takeaways in there. It's been so good, and we really like your perspective on the crowdfunding. And yeah, there's still hope, I think, is what you're saying. It's not completely done and dusted. There's still investors out there. There's still people with deals, and we just need to get our heads together and find a new solution, I think might be the case. One that works for the FCA and everybody else, though, and that might be the hardest thing ever to try and come up with. But yeah, there's still work to be done in the property market in the UK, I think we're saying. Yeah, but thank you so
Yeah.
much for joining us. Your feedback and your insight, as always, is hugely valuable, and really appreciate it.
Thank you for having me.
Okay. Thanks very much, everyone. Thank you.
All right.
Bye-bye.
Thank you.
Bye.
Bye.